Welcome to the Investing Master Series. My name is James Boyd. We welcome you here today on this July 8th. Hopefully it's smoking hot where you are. I'm currently in Salt Lake City, and it is smoking hot. So anyway, been watering the grass twice a day. So go figure. Hello, Don, Spanish, WW, KB, Arthur, and many others. We also have Connie Hill in the chat. We welcome her as well. Now, I normally teach at this time. This class is being recorded. And also, I will share with you some links where you can actually find us just real quick. So as we get started, remember, this is not a one-off class, and you're going to see that this is our page right on YouTube, okay? You could just click on subscribe, dead center when you pull up that page if you have not subscribed already. Second, if you could also go to this, this link, which is going to lead us to the playlist for this class. And let me send that playlist right there. And that's going to give you the playlist. And so you can actually see other classes that we actually did historically and just kind of put those in a bookmark, okay, folder. And also want to give us a quick reminder that we also do posts on X. Connie and myself, we do post educational content on X. So take a look at that as well. And as we get started here, I want to give us a quick reminder that with what we discussed, we'll talk about stocks and options. Remember, when we talk about options, remember that options carry a high level of risk and are not suitable for all investors. Also remember, when we talk about the information here, it's provided for general informational purposes only. And also remember, when we talk about examples, they are done on the Paper Money software application. There's also other applications like web-based and mobile as well, if you want to actually use those, and there's reasons to do that. Be aware of those as well. Also remember that investing involves risk, including loss of principal. And also remember, as we get started, remember when we talk about short options, whether we talk about selling calls or selling puts, those can be assigned, okay? If we did a covered call, our shares could be assigned to somebody else, meaning we lose those shares. If we sold the put and we have an obligation to buy, we could be assigned to buy those shares, which means the investor becomes the buyer of the shares at the strike price. Since we're talking about American style options, that can happen prior to expiration. Now, as we get going here, we will talk about market conditions. We are officially in trend 4, and we'll talk about what that looks like on the charts here and some sectors and some strategies when we're in that condition. Now, we'll also talk about some current positions. I would like to dive a little deeper into the paper money portfolios that I think have some really good examples of management of different strategies, okay? And the one thing is, you don't want to be weak in the area of management. Matter of fact, when the market actually has low volatility, that's when you probably want to manage more even, because the trends could be starting to pull back or flatten out. Now, we will also talk about current positions, yes, in the paper money portfolio, but we will also bring up a number of new examples as well. So a lot to learn from here today, and I think it's going to be some great discussion. So first off, when we take a look at this, I want to take a look at this trend column, okay? Now, the market has kind of been waffling back and forth between trend 3 on the NASDAQ, trend 3 on the Russell, trend 4. Now, if you've been watching this morning, we've kind of been going back and forth. And that just means that the price on the SPX, NASDAQ, Russell, and Dow Jones has been falling down below the 10-day exponential moving average. So if you keep an eye on that, that's been happening this morning. And if we continue to see that, that actually just means that we're losing some momentum in the price. Now, when you look at the VIX, one thing that we've been, well, let's use the word lucky so far, we haven't really seen the VIX explode, okay? VIX is still down here at 1683, okay? Down 5% here today, but you got to remember it's a low price index. And if you look at that, it's, and the other thing we're not seeing is we're not really seeing an explosion in the yen. Matter of fact, we call that the international VIX. Matter of fact, the VIX, the international VIX has been dropping. Okay, so not a whole lot of fear, and the semiconductors still holding up in trend 3 condition. Now, I do want you to notice we go into a lot of earnings here. when we look at, let's say, the IV percentile on the indexes, shockingly low. The IV percentile on the SPX is at the 10th percentile. That means 10% from the, that means we're talking about the 10th percentile from the bottom, okay? And if you take a look at, let's say, the 11th percentile for the NASDAQ, 18% actually for the Russell, 29 for the Dow Jones. So really low IV percentile for the SPX and the NDX. Keep an eye on that. Now, what I do want to actually kind of bring up is a couple things that kind of have stood out a little bit. Well, so first off, some of you might be watching. We've seen interest rates come back up a little bit here in the last couple days. Pretty good pushback to the upside, okay? It's been interesting as they got that big, beautiful bill passed. We actually saw rates shoot up. I mean, who's going to pay for it, right? And if you take a look at this, that's about an 8% rise in the rates, 4.2, 4.25, and I should actually say 20 basis points or 0.2%. That move, just to confirm, yeah, about a 5% move to the upside in the rates itself. Okay, keep an eye on that. The other thing we were going to keep also an eye on is some investors have been watching Bitcoin. Could that rally to the upside? We know that the dollar has been under severe pressure, and this has been an area where we have not seen new lows. Matter of fact, we've been building a base of support. If an investor is sleeping on this, they don't understand how support levels build over time. When you actually pull this up on the 3-year weekly chart, this is breaking out on a weekly chart. And actually, this is starting to really hold that 10-week moving average by continuing to stay above. Some investors, they go to sleep when they actually see these grinding out of supports. But actually, these could be the ones that actually, the technical analysis, to say the stronger the base, the stronger the potential push to the upside. Keep an eye on Bitcoin. That's one that many investors have been watching. Now, the other one that we're going to keep an eye on is crude oil. That's actually one that Art has been talking about. It's looked a little bit better over the last 4 sessions. A little push on 7.2. We saw bullish engulfing on 7.7 and a little push here to the upside. Now, we're not trading these products, but we're looking at the price levels, okay? And so obviously, if we're talking about crude oil, we're thinking about energy sector. We're thinking about energy stocks. Now, the other one that we're going to keep an eye on that's kind of been holding up there, it's not hit a brand new intraday high yesterday. It was silver itself. Silver actually sitting here at about, what do we got? 36, 37 or so, holding up fairly decent. Gold, a little bit more under pressure. Some of us might kind of say, well, I'm glad gold's under pressure. Maybe people will buy more stocks instead of gold, okay? So there's kind of good and bad there. Now, what I want to do is I want to kind of bring up just real quick the sectors, and then we're going to talk about some positions. When we look at, let's say, the technology sector, that was at a brand new high. I don't know why that keeps switching back. That was at a brand new high just on the 3rd. So on Thursday, okay, brand new high. Is it falling to pieces? I can't say that, but it kind of has paused a little bit. Now, when we bring up technology, we would also bring up transportation. Again, we're going to keep an eye on Uber. Okay, we talked about that yesterday. Since we talked about T for technology, we'll say T for transports. Now, speaking of, let's say, a sector that might, the reason why we look at the futures price is because we say that futures price might then go into the sector. And then what's after the sector? It's individual stocks. And if you look at, let's say, the energy sector, a decent little push here. Now, Captain Obvious would say, don't forget about maybe just the sector in general, okay? No one said you had to buy the individual stock. Someone might say, I'm just going to buy the energy sector. Now, if we said, well, what 2 stocks really represent a huge, massive portion of the energy sector, it wouldn't take very long to figure it out. Exxon and Chevron. And if we look at, let's say, Exxon and Chevron, what you're going to notice is they've actually had a pretty big push up here. They've been doing a moving average crossover. Okay, now that moving average crossover, if we zoom in on this, you're going to see that it really went down for a day. And then so far, this is today's candle, bullish engulfing right back to the upside. And that green dot there is really showing at the current moment in time a close above the high of the low day. Now, that's Exxon. You look at, let's say, Chevron, that's the one that's slicing through that 149.5, and you're really seeing about 158 and change. Now, I want to kind of talk about these two stocks right now, okay? Now, let's kind of just bring up in the paper money portfolios, okay? So is there any position? So we have a short put of Chevron. Tell me how to manage this position. A, do we just hold it down to the very bitter, bloody end? Or does the investor say, you know what, this is the most the investor can make. This is where the premium is now, and I don't want to give anything back. Well, the problem is you can only make another 50 cents, okay? So if the investor said, well, if we just try to get out now, we could try to grab the 190. If we try to wait and try to grab the last remaining 50 cents, you could risk the 190 and more. So that becomes what we call a poor reward to risk ratio. This is like a 1-to-4 reward risk ratio. It's worse than that because it's not including the risk that you could give all the 190 back and be down, okay? Now, what we're going to do in this example is we're going to roll the position. When does an investor roll the position? They roll the position if they think the price could keep going up. So I'm going to ask you a quick question. If we looked at this chart, does this chart kind of give us any idea that this chart might try to continue to go to the upside? And I want you to think about when you roll a position, you're exiting what you have and you're entering a new position. So if we were looking at this as a standalone new position, would the investor maybe consider getting in this position? What's the foundation for getting in a position? In an upward trend, identifiable support, price above the 10-period moving average. Okay, now that's the stock itself. On the backdrop of that, you sure would like the sector to at least be going up as well. Kind of have a tailwind perhaps. Now, if we looked at this, if we went back and said, okay, how do we just close this position out by itself? If we just want to close it out, right click, create closing order, and just buy it back. Now, what you're doing is when it has 52 cents, you're giving back 52 cents of the initial credit, which is where it's in the account, okay? And what we're going to do here is, that's if we want to just close it. This is simple. This is probably for most people, that's the easiest way to initially learn. If you say, well, I'm going to just roll the position just means we're going to buy it back and then sell a new one. And instead of being one row, we're going to have two rows. So if I click on create rolling order, you're going to see on the bottom row, there's what we're buying back. The 18th July 145 put. Now, what we're going to do is we're going to go back and, as Bill would say, rinse and repeat. If we go back to the options that are 20 to 50 days to expiration, and we look at the monthly options, that would be 15 August options with 38 days remaining. Now, the one thing we got to remember is when you look at Exxon and Chevron, they're not extremely high in terms of the implied volatility. This is not like a semiconductor stock, okay? So the investor, if they said, well, to get at least maybe a little bit bigger premium, some investors might say, James, I would like to maybe try to get maybe 2.5%-ish. And if the investor said that, they might be selling a strike higher, okay, higher than they're maybe used to. Now, what are the three strikes we have on the table? We have the 150 with a delta of 43. We have a 145 with a delta of 28. You have a 140 strike with a delta of 17. Now, if we solve the 17 delta one, has a return on risk, option premium divided by the current stock price, about 0.9%. We actually look at the 145, 1.62%. And that really is, think of that as like the option yield. If we took a look at the current option price divided by the current stock price, it's going to be pretty close to what that return on risk is. What we're going to do is we're going to go the 15 August, and we're going to sell the 150. And now what you're going to see is it's going to give us a net credit. Now, that is littered all over the option course, where we talk about consider rolling if you can do so for a credit. Well, Captain Obvious. I mean, Of course. Because if you can roll for a credit, you're profit taking on actually what you have typically, and then there's something remaining, and that something remaining is a new premium on top. Now, Alan says, when managing options, do you ever re-enter the trade? Is this a good practice? And what is the practice? Well, so you re-enter the trade if that trend is still going. And we're talking about in a bullish position. Because, Alan, what we have to remember is if some of these trades we actually have, there's a cap gain on it. Well, just because there's a cap gain and the investor actually has maybe a good percentage of the maximum gain, that does not mean the trend is over, right? So if the trend is not over and the investor is, let's say, run out of time and or cap the gain or close to it, the investor might say it's still a bullish trend, okay? That's what we're talking about. This is a re-entering of the position, but it's just re-entering with a different expiration and a different strike. Now, what we're going to go ahead and do is say confirm and send the order. Now, if we take a look at this, we're going to send that. Now, a lot of times people will say, well, I don't understand why it says diagonal. You don't even need to look at that. A lot of times when you bring this up, if you don't change the expiration, it'll say calendar. It just is thinking that you're doing a calendar or a diagonal position, but really you're rolling the position. You don't need to pay attention to that. If it says diagonal, it's telling us we're getting out of 1 month and reselling a new one. But we don't really need to pay attention to that. But we know if we did 1 month and we sold a different month, it's going to be a diagonal. But the position, it doesn't understand that we have the position. So it's not going to be a diagonal because it's getting out of the one that we have. So the only thing that we would have is a short put position. That's why it doesn't matter about the calendar diagonal. Okay, send the order. Now, I want to go back to this, and we can't assume that the position is going to fill. So when I look at this position, we're going to look and see if we can't give it 2-3 minutes and see if we can't get a fill. Okay, so we get a fill. Now, what do we have now? So remember, we kind of said we don't have a diagonal. What do we got? We got a short, we got a cash secured put. Trade price 405, market's 407.5. It's not unusual to be slightly down when you initially get in. Welcome to the bid-ask spread. And now what you're going to see is now we're in a bullish position with a delta of 44. And if you have a positive delta, you want the stock to go up. Positive delta, positive theta. This is actually where we want the stock to go up, time to go by. And anytime we talk about selling calls or selling puts, there's also going to be negative vega. So you actually want volatility to go down and thus actually bring down the option price. So you can try to buy it back for cheaper. So that's trade number one right there, which is actually, I think, a pretty good example. Now, I am going to go back to just real quick to the Exxon. Now, what's the risk? Now, I don't know if you guys have ever done this, okay? Have you ever thought, man, I'm going to do Chevron and Exxon, and they're two individual positions? And then you realize they weren't. Has anyone ever done that before? Now, what I'm going to do is I'm going to clear the drawings. And what I'm going to do is I'm going to kind of show us something. Let's go to studies. Let's go to quick study. And we're going to go on compare with. And I'm just going to overlay Chevron on top of Exxon. And we're going to look and kind of see, the line chart is going to be Chevron. And ExxonMobil is going to be candle. And if I actually bring this up, we're just kind of wondering, do these stocks go in a similar direction? Now, what you're going to notice is when it looked like the purple line went down or that fuchsia line went down, the candlestick chart, Exxon went down. When we actually saw the fuchsia line go to the upside, we saw Exxon go up. Now, they're not moving at the same percentages per se, but the direction, okay, and the movement is pretty identical. Now, sometimes as people, we can be a little greedy, can't we? It's okay, okay? Everyone gather around, say, I'm greedy. And so the biggest actually thing is someone might say, well, what I'm going to do is I'm going to actually get in Exxon as well. I think where the investor might say is, can I get in something that it maybe is not in the exact, it's in the same sector, but maybe it might just be a little bit more into drilling, not like what they call an integrated name. Speaking of this, I want to just take a quick peek at two other stocks in that space. And the two others I just want to look at, one that's actually been quite bullish has really been, let's say, Valero, okay? And if you look at Valero, that is one where we had a resistance right about 143 and change, and it's gotten above that. In the last couple of days, it's actually had a pretty strong bull flag pull. When we talk about a bull flag pull, we're talking about something that maybe went up 5 to 8 days or so. In those 5 or 8 days up, you might have 1 or 2 days of that are down. Here, we didn't even really have a down day. Just went green candle outside that day right there. That was the only down day. The key word is so far. So I want us to keep an eye on, let's say, Valero, which is actually kind of getting out of a basing pattern. And if you take a also look at, let's say, PSX, which has also been another quite strong one. Now, in our example, what you're going to notice is this kind of has like a downward sloping line of resistance. And we could draw many lines of horizontal support. Fine. Okay. And if we kind of look at this on the right-hand side and draw it up from the lows to the highs, it kind of looks like we got out of maybe like a symmetrical triangle, if you will. Higher lows, lower highs. Now, in our example, what we're going to do is we're going to use Phillips 66. Okay. Now, does it have a relationship to Exxon and Chevron? Sure. Does the chart look completely identical? Not as much. Matter of fact, Phillips 66 went further down. But what we're going to do in this Phillips 66 is we're going to come back to this trade example. And let's say the investor said, James, I want to play a bullish move on this. And I really want to, let's say, first off, let's take a look at is it even tradable? Like in terms of stock, the options, etc. Here we are about 2 hours into the market day. We're over 1 million shares. Okay, well, that's good. Okay, because we like 1 million shares on average for the day. We got 1 million shares in the first 2 hours. Okay, fine. Now, we're not looking at the 18th July with 10 days. It's just too little time. Okay, we're trying to get out with 4 to 10 days, not start a position with 10 days. Okay, so the earliest we would be really probably looking at least to look at would be the monthlies in our examples. And what I'm trying to really look at is the at the money call, the at the money short put. And if you look at this right here, you're going to notice that's $1.20 wide. And this right here is, let's say, 20 cents wide. That is not very attractive. And if you look at, let's say, these ones right here, which is the at the money strike, 40 cents wide. And you're going to see if we kind of look at the at the money over here, it's 20 cents. Now, notice as we're kind of looking at it, the liquidity is changing based upon orders to buy or sell. Now, what I'm also going to do is when we look at the open interest, where do we see more open interest? It's really right at the 130. So remember, we don't want to buy and sell to ourselves. We want to buy and sell to an active market. Okay? So how do we know if it's an active market? The higher the volume, the higher the open interest. There's some interest at this moment in time. That interest can change. Okay. Now, what I'm going to do is I'm going to right click on that, ask for the 130, and we're buying the 130 call. Now, wait, if you buy a long call, think the stock's going to go up. Okay. Now, if you bought the long call by itself, okay, if you bought it by itself, unlimited upside, negative time decay, right? Positive vega. Volatility. If volatility goes up, it could help. Some investors don't like to just buy a call by itself because there's negative time decay, meaning the stock has to go up just to even get to break even. Some investors don't mind to cap the upside off by selling a call. By selling a call, you get a credit, and it pushes down what the investor overall is paying for the 130. So in other words, the debit is not as high because you're selling the 135 call. Welcome to the long call vertical. We know that if we have the right to buy the shares at 130, we pay a net debit of 223, we really get a break even of 132.23. We click on confirm and send, and we see there's the break even. Now, when you look at a classic like long call vertical spread or long put vertical spread, in my mind, without even looking, I'm thinking it's going to probably be a 1-to-1 reward risk ratio. A little bit higher. That can sometimes depend where the stock is to the strike. And what you're now going to notice is we can see the potential max gain, max loss, and the commission. Now, what we're going to do in this account, we're going to sell 2 of these. Matter of fact, we're not going to just do it in the margin. We're going to go in the margin. We're going to go 2 contracts. That's the most we can do there. And in the IRA, what we're going to do is 3 contracts. Okay. So in our examples, if it's good enough for one account, why wouldn't it be good enough for another account? I mean, if you're looking for uptrends, relative strength, things like that, as long as you could position size for it, why not for these accounts? Now, what I'm going to do in this case is we're going to go ahead and send the order. And just to kind of give us a quick reminder, what is the debit? 223. Send the order. Okay. Now, so the question was, what is this called? This is just called a long call vertical. Quick reminder, if you looked at a long call vertical, why would someone do a long call vertical versus a short put vertical? Short put vertical is more about probability. It tends to be more forgiving, but you don't make as much. If you did a long call vertical, you have a higher potential upside, okay? But irregardless, both have a built-in maximum loss and gain. The long call vertical, no time decay typically. Short put vertical, since you're getting a credit, you have positive time decay, okay? Now, let's actually go back to just real quick. I want to fast fire through just a couple stocks that are kind of standing out a little bit in the marketplace. Cisco, and we'll come to Cisco in just a sec. Cisco's kind of been one that we've been really watching over the last couple of days. That's kind of entering the flag portion of this move. Now, on our charts, we know that if we're kind of getting to that flag, what color candles are we probably starting to get? Answer, those orange or orange color candles. If we get orange color candles, that means the stock is starting to close below that blue moving average line. We're losing momentum. Now, no one has a crystal ball on what's going to happen today or tomorrow because we don't know what orders are going to come in. Now, but the moral of the story is when you start to see this pull back, okay, when you get the green candles, feels so nice when you get those. Feels very nice. Some of you are like, your eyes just rolled into the back of your head. Maybe they did. But if we take a look at that, that's your pull, right? Now, when we pull back, if we only get the orange color candles, this was a pretty shallow pullback in percent. And the duration of the pullback was probably short as well, okay? Now, we're going to come back to that in just a second. But the one I want to kind of bring up is when we also go back to, I wanted to bring up that stock because it's a stock that we have that we've been watching, but we've also been watching its twin cousin, and its twin cousin is Oracle, okay? Oracle has been the one that has not been pulling back like Cisco, and that's been going to the upside. We do have a paper trade that we will talk about, okay? But speaking of kind of a couple other stocks, I want to go back to a strategy that we talked about yesterday. And that strategy was really being long the shares of the stock. Long shares of the stock just means you own them. And what you're now going to notice is Newmont Mining, which is a gold stock, it's coming down, or it came down, okay? Now, what you're now going to notice is if we sold a call to the shares and the sold call, what would that be called? And the answer to that is that's a covered call. And what you're now going to also notice, if we also have a long put below us, that gives us a risk profile diagram that looks like this. Okay. Now I'm going to tell you, you can learn a lot more in the stock market when the market pulls back. Really, I think people get exposed. How much do you really know? How skilled really are you? If the market's just going to the upside, you might not have to be very skilled at all. If you have some positions and the market goes up, it can just mask ignorance. Okay? Just the truth. Okay? Someone just gets in, they ride the trend. It doesn't mean they know a whole lot. They could just be in. And the market is going up, and it doesn't really tell you the skill level of the investor. But when those markets are, the stock or the market is pulling back, all of a sudden it really tells you, do you know about risk management, portfolio management? Do you know anything about, let's say, risk mitigation and option protection? This is where you really find out, what do you really know? Now, some people are like, I don't like to feel like that. Tough, okay? Markets don't just go up, they come down too. The goal of the investor is to really try to protect the capital. Now, in this example, what I want to show just briefly is I want to kind of just show when it goes down like it is so far today. We know that if we had 100 shares of stock, and if you take a look at this, the stock is down $2.71. We know, duh, right? The shares would be down $270-ish. We know that. You don't have to be an option trader to know that. Have 100 shares, stock's down 270, stock's down 270-ish. Now, but what you're going to notice is the short call and the long put, those positions are up. Now, this is where you scratch your head and say, wait. How are those positions up? Anybody know that? How are those positions up? Well, these positions of selling a call, that's a bearish position. Long put, that is a bearish position. So if the stock actually goes down, they could benefit from the price decline. Now, this is the hardest thing for people to understand, because they're just thinking about, I just got stock. But really what you got to think about is, when you bring these three positions together, the net of it is you have a delta of 40. So if we, for example, did some basic math here and said, you know what, I want us to imagine that the 40 delta is like 40 shares of stock, okay? So I want us to imagine that we got 40 delta, or 40 shares of stock. And the stock today went down $2.73. Now, pull out a calculator. Where's the calculator? Now, if we take a look at this, if we had 40 shares of stock and the stock went down 273, we're thinking we're probably going to be down somewhere in the ballpark of 109.20. Okay? Well, where are we at now? Well, if I looked at this, and so let me just remind us, okay? 40 delta, 40 shares. Okay? Times it by 273. Where'd you get 273? That's a stock movement today. What do we think the loss would be? Probably about 109. If we actually went in today and said, well, how much are we really down? 119. We're about $10 off. Why is it a little bit worse? Well, Delta can move slightly on us, but it could also be the bid-ask spread of the options as well. And if you take a look at this, if we had shares only, we'd be down 278. But since we have the protection on it, we're really down 119. So if you think about something, 119 is how much we're down with protection. If we just had shares only, we would be down 279. I'm going to ask you a very, very, very difficult question. Okay? Would you rather be down 119 or would you rather be down 279? And so the moral of the story is, it's down about 42% of what it could be if the investor just had shares. Now, what's the drawback of this? The drawback of this is the investor has, in the shorter term, a capped upside. They might not even care about that upside, capped upside, especially if the stock is below the moving averages. Now, this is very important to understand. If we actually pull up the chart of NEM itself and say, what does that chart look like? Answer. This is what the chart looks like. Now, remember, in our examples, we're trying to look for stocks that are above the moving averages. But if those moving averages are red, which they both are, and if we look and see the price is below the moving averages, this is not something that we would say, man, what a great entry setup, okay? Because we're looking for the prices to be like this, something like that. But when we're priced below the moving averages, we're losing momentum and we're losing the trend. So we said yesterday, when the volatility is low and starting to build, having an understanding of using collars is very important, because what we're trying to do is we're trying to minimize the give back on the position and we're trying to protect the shares. Now, the other question, which actually has come up in the chat, which is, could you actually bring up Uber? All right, so without even looking at Uber. Now, I don't know if that position filled, but we're going to find out, okay? Let me actually just take a quick look. Did Uber fill? Okay. I got to pull that up. Did Uber fill in the margin? IRA. Pull it up. I don't, oh, there it is, position. Now, I want to just kind of bring something up, and let's just kind of remember something, okay? So if, let's say that we got in Uber yesterday near the close, okay? And the stock here today is down 64 cents. All right. Can anybody remind us, when we look at a typical collar, a collar would have a delta of about what? What is it? Delta of about what? We got 100 shares of stock. We need 100 shares. We sell a call with a delta of 30 to 40. Let's just say that delta was 35-ish. We pick something in the middle. When we actually bought the put, it had delta 30 to 40, both out of the money. Let's say we just picked something in the middle and the delta was 35. So when you look at a collar position entirely, it has a delta of about 30. What's your point? Well, so our delta exposure currently is 30. Now, remember, that's just kind of saying the change, a little triangle there. It's the change in the stock price, okay, over the change, a little triangle, in the option price. Okay, so if we had a delta of, let's say, 30, and that stock went up $1 or down $1, the net is it would move the option price about, let's say, 30 cents up or down. So we want to kind of find out if the stock goes up or down. How much is it? How much do we gain or lose by unrealized gains? Well, we can look today and say 61 cents. Well, if our delta was 30 and the stock actually goes down 60 cents, how much do you think that we're down without even looking? Answer, probably down about 18 bucks. Could it be worse? Sure. Could be the bid-ask spread and so on those options. But we're probably thinking this position is probably, since the stock is down 60 cents, we're probably down about 18 bucks. Okay. Now I'm going to tell you right now, one of the hardest things in the stock market is people talk about riding trend. It's so easy when you look back. Duh, all you had to do is ride the trend. But the problem is, when you look at the upward trends, there's little red candles, and those red candles fake us out. Red candle fakes 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 us out. And all of a sudden we look back and say, every time we saw a red candle, we just sold. Why? Because we got scared. Well, the one interesting thing about collars is it's sedating or pushing down what the delta is. And so you probably stop selling every red candle and you try to ride that trend. Giddy up. And I'm telling you, I mean, people say, oh, it's easy to ride the trend, but sometimes as investors, we could be our own worst enemies. I'll just leave it there. Okay. Now, when we bring this back up to Uber, I said, how much is it down? Now, we don't know exactly where we got in yesterday in terms of where the stock was, but if we look at kind of where we are, we're kind of flat, okay? We're not even down $18. So when we look at this, say, oh no, we're down, stock down 60 cents. Well, you got to remember something. Our delta is not even 30. Our delta is 22. So that tells us that the deltas that we picked on the call and the put, for sure on the call, is a little higher, and it's pushing the delta down there. So if the stock was down 60 cents, we had a delta of 22, we'd be thinking we'd be down about 12 bucks. Okay. I'm telling you, there's a reason why we talk about these callers, because it gives us an ability to go through some volatility without having big underlying profit loss movements. And it allows the investor to really learn how to ride through volatility, but also having a built-in right to sell. Now, I want to kind of say this just real quick. When this position is on, the investor is not really trying to gain on the long put. If that long put becomes worth something, it means the stock has gone down. Boo to that. Because if the stock has gone down, the paid money account has the shares. So does the investor want to put the gain value? No. Now, what is really the only side of the position that we're managing? Answer, it's the short call. And the short call can be rolled, in our example, 1, maybe 2 times. And that's the only side of the position that we're really managing. If the investor can grab 50, 65, 80% of that, they might roll that call to the same expiration, okay, that we're in for the long put. But the goal is, in the next 38 days, can the stock continue to close above that long put strike? We said yesterday, if in the 4 to 10 day window, if that stock is set to close below the long put strike, the investor could exercise their right and sell those shares of stock. Because if that stock is closing below 92.5, we have to bring into now question, is this stock, is it still upward trending? Is there momentum? Is this stock below support? Now, a lot of times people think, well, that's really hard. How do you exercise that put? Oh, it's extremely tough. If the investor wanted to exercise their put, right click on the put itself. And you'll notice, like right, just hit me in the face. Right click on it. Exercise. What does that exercise mean? Well, wait, if you got a long put and you want to exercise your right, that just actually means in this case that you would be selling those shares of stock. Okay? So if we had a long call or a long put, we had a long call and we exercise our right, we're buying shares of stock. We have a long put and we want to exercise our right, we have a right to sell those shares of stock. And why would you want to sell those shares of stock? You do not believe that stock is trending anymore. Okay? And you want to get rid of those shares. So if you sell 100 shares and you have 100 shares, how many shares do you have? Answer, 0. Okay? So this is really important. I'm going to tell you right now, okay? People can talk about buying puts. You could talk about put verticals. I think the caller strategy is the most least known, least understood strategy, and might be a strategy that investors, if they had a competent teacher that actually really had some understanding, they would actually say, man, maybe I overlooked this strategy. Because we know, as Jane and John, we know they have stocks. We know that they probably have some ETFs. And sometimes those stocks go down or ETFs go down. Now, a lot of investors say, well, look, I don't want to get in, get out, get in, get out. But sometimes are there points where the investor says, I want to try to protect the capital without potentially selling the shares. Now, wait. What's a big point on this? You got to remember something. If you sell a call at any time that that call is there, that you sell it, someone could take those shares at the strike price. However, if the investor said, hey, James, I got those shares for 95.83, 3 days after I sold the call, someone bought my shares at 100. Now, I'm not sure if you'd feel horrible about that because you sold it higher than what you bought those shares for, but that is a risk, okay? And it kind of depends upon what type of account you're in, okay? Maybe a margin account, is it like a 401k, and so on, why someone would care about that transaction, okay? So that's up to the investor to kind of go through that. Do you know what that might mean, etc.? And I'm out of my time here today, but we had a great discussion and try to answer some of those questions at the very end. And also, so like I said yesterday, I think you should go out and practice really 2 of those callers and then see what happens on a day-to-day price movement and then hold them down to the 4 to 10 days expiration. You're going to learn about what a stock position does as it goes up or down, the put position and the call position, and then think about what is it doing to the position as a whole. Now, I'm out of my time here today. We talked about some of the energy stocks here today. Keep an eye on those. Also remember that coming up next, we have Cameron May teaching the cover calls and cash secure puts class. I want to thank you for your comments and your questions. I think we got into some nice conversation there, a little deeper, but actually that's where the meat really is, the tender meat. And also with that, remember that with what we discussed, it was done for example and illustrative purposes only. And this has been the class on the Investing Master Series. Thank you, Connie, and thanks to all of you. Have a great day. Take care. Bye-bye.